Greetings, everyone. So today is Saturday. I just building a couple of indicators based on the chart training that I did the other day, um, where I went over some basic chart trading principles. And I just got it in my mind that it might be kind of cool to create a series or create a couple of indicators that um, utilized some of those indicators and strategies that I had shared the other day. Kind of put them all together in a simpler to kind of see and be able to analyze format. And that's what we have here. Now, these are invite-only scripts. I didn't publish these to TradingView for public, so these are just going to be shared with our group. That's what they were created for. So if you would like access to these scripts, I'll be more than happy to share. But before I do that, I want to kind of just go through what these are and what you can do with them, how they can help with your trading. Now, with the previous training, I had mentioned that the purpose of indicators was to help us to better understand what price action on the chart is doing, they help us to visualize the movement of price in ways that might be easier to digest. Um, Indicators by themselves, they're not magic by any sense of the imagination. There is no one indicator or combination of indicators that will ever be able to perfectly predict what price is going to do. Even the steady stack indicator, as good as it is, and obviously that's the $2,500 a year one. It's not going to be perfectly infallible. It is going to provide false signals at times. It is going to be victim of subject bias, meaning people looking at it will draw different conclusions from what it's showing. And so there is no one perfect indicator that will be able to perfectly predict. The purposes of indicators are just to help us better make sense of the information that's on the chart. From that, we make decisions on how we're going to react to that information. So just jumping in, real quick, you see on this chart here that there's a few things to point out. So the bar colors of the chart, you'll see that they're red and blue. Now I showed an indicator the other day that it was called the auto trend system, and it looked similar to this. I basically replicated. I didn't steal it or anything. I worked through OpenAI just to be fully disclosed. I don't know how to code in PineScript, but I do have a sense of what is, as far as what is behind indicators, as far as the mechanics and how they're calculated. And so using that knowledge, I can use OpenAI to help develop the code side aspect of these indicators. And that's, with AI, that's one of the things that I highly recommend anyone doing, is getting good at using AI as a tool to help you solve problems. To me, that's basically all I wanted to do. I wanted to create some indicators that had certain parameters that did certain things. So I formulated kind of my general vision, put that into the Chat AI as a prompt, and I do have the Chat AI or OpenAI Plus subscription, so I have access to GPT-4, so I use that. It's a great resource and tool, so I highly recommend anyone who maybe hasn't jumped on with that using it, because it definitely is a good problem solver. It's a great tool. It itself is not infallible. It's a language model. So, I've had, with each of these, with this one here on the chart, and then this down here, this oscillator, I had to do several reiterations, um, go through several repeats, because the chart, or because the AI, um, it will sometimes do some pretty silly things, like uh, parts of the code snippet that don't need to be duplicated, or use outdated methods for calling certain functions. And so it can do some very silly things. So you have to babysit a little bit too. But it does do the heavy lifting, and work with it, and you're patient with it. It can definitely deliver some very impressive quality. So what are we looking at here? I mentioned that the bar colors were coded the same as the auto trend system. Now that auto trend system I paid like $500 or $600 for. Those for the lifetime license that they were offering at one point. I don't think they're offering that anymore. I don't know, but this isn't this. The way that this was built isn't going to be built using the exact parameters that they use, because for one, um, they don't have that information public. Their code base is not public information. And two, I wouldn't do that. I wouldn't take someone else's word, tweak it a little bit maybe, and then try to pass it as my own. Even as a privately shared indicator that I had no, intent of commercially licensing or whatever, I still wouldn't do that. That's just wrong. So, for me, I had to kind of guess what was behind it, and also based on my own knowledge of what components can be used to identify trend and momentum, based on my own knowledge of trading, and that's really what I leaned on, was that. And then all I did was simply have the program just color the candles the same colors, just for basically continuity, basically from what I shared from my last video to this one. I just wanted there to be congruent. So we see that the candles are colored the same, each color representing a certain sentiment and trend, um, with blue representing a detection and uptrend, and red representing a detection of downtrend. Now you'll notice something, and I didn't change this on purpose. It can be changed in the candle settings that are on the chart settings, but I didn't want to do it for a reason. Um, the wicks of these candles, you'll see, and just to be clear, we're on Heikin Nashi, which is by itself a trend smoothing setting for candles. Basically, it basically helps to smooth the movement of candles. So if we toggled it to regular candles, you'll see that there's a lot more movement. And you'll see that the colors of the candles aren't too far off from what they were under Heikin Nashi. So for me, I just like Heikin Nashi just because I like having a little this jarring kind of up, down, up, down, up, down. Can kind of make my eyes hurt a little bit. That's a personal preference. However you do it, you may want to have regular candles on, because it might give you a better idea of the range of movement of each of these prices. You may want to have that. You may want to employ candlestick analysis, being able to look at candlestick patterns. Something that you really can't do very well, or chart patterns, something you can't really do well with Heikin Nashi, because of the fact that setting changes kind of the visual structure of the candles, whereas with regular candles you can actually do that. So there's going to be different preferences for everyone. It's going to be based on how you trade. Now, I didn't change the wicks, and I did that for a reason. The idea is that the body, kind of where the eyes are drawn, would represent the detection of trend. But if you look at the candles, you'll see that there's some where the candlestick itself, or excuse me, the wick itself, is a different color than the body. And I did that because that gives us another piece of information, right? So, in trading, our goal is to try to compile as many, and again, useful pieces of information so that we have the ability to make useful decisions, accurate decisions. So the wicks, they represent the color of the candle itself, the whole candle, as it would appear on the default chart settings. So this gives us a little more information and may even give us a little bit more of a heads up. You'll see that, for example, this curling down right here, the candles are still blue, but the wicks are red, meaning if we were looking at this as a default chart, these candles would already have turned red, right? So this may give us an indication that is counter to what the actual indicator is. And we can use that piece of information to basically make decisions on how we're going to manage this trade. Now, by all accounts, if we look at everything else here, every other indicator, and I'll go through them, every other indicator on this chart is still telling us that this isn't uptrending. We're still uptrending. And this curl back down doesn't necessarily confirm a reversing trend by itself, right? But we can use this information to get an idea of where the market may be thinking of heading, and we can use that to be more prepared to take action, which again, if you watched my last video, that's what we're doing in trading. We're taking action. So there are components to this indicator, and I'll get to this oscillator down here at the bottom in a little bit, but there are components to this indicator. So again, the blue candles representing an uptrend. Again, when there is a change in trend, at the onset, you'll see these arrows below the first candle of the change in trend. So green up arrows representing an uptrend, red down arrows representing detection of a downtrend. Now, again, this doesn't, what we describe here, as far as indicators being infallible or not being, or and so on. You'll see here that this fired a down signal, and yet you'll see that very quickly it reversed direction and became the first leg of this uptrend that it detected here. So they're not infallible. They're there to give us information, help us make decisions, but we can't learn to depend on them. See, even by this, everything flipped to confirm that this was a downtrend, so to speak. The only thing I would say, and again, this is why with indicators, and when I build indicators for myself or use indicators, I don't use just one indicator by itself. I will use different indicators to basically different indicators to provide additional layers of confirmation. So you'll see that the one thing that may have saved us from entering this trade is this 921 EMA cross. And I mentioned that as well in the last video. So I put this 921 EMA cross as well on this chart, again, because it's a tried and true system, and because it provides an additional safety net for us. So we'll see that the arrow fired down here, the candle colored red, this up here, the parabolic SAR, it flipped So by all and there's a setting I programmed into this indicator so that when the PSAR flips directions, it'll color the background. You'll see it's kind of faint here, and you can adjust the color settings to be brighter or dimmer. But it changed the color. It changed the background, and I'll actually adjust that now because it is a little difficult to see. I don't want to make it too bright. But you can adjust pretty much all the settings in this. It flipped the background to red, representing it detected a downtrend. So when we have the PSAR on top, that's a downtrend. But you'll see that the 9 and 21 EMA didn't cross until here. Now, again, this is where having these wicks is also important because look, the wicks are green. Wick is green, and when we have this really thin indecision candle right here. Now, again, this is where combining multiple things together is inherently important. So we have the cross, and this little arrow here represents a cross. I couldn't figure out how to program it to be directly at the cross. So the arrow, again, a down arrow for a cross down. So when the 9 crosses below the 21, it will produce a yellow down. When it crosses above, it will produce a yellow up. I kept these the same color to avoid confusion with these arrows here. And so you see that we don't have the fire of the cross until here. But if we're paying attention to the candles themselves, we see a very strong indication candle here, or indecision candle. And when we see an indecision candle like this, when you have a very, very thin body and disproportionately longer wicks than the body, then you know that the market hasn't decided which way it's going to go, right? We've had an up, and then we've had this down, and then the market's just sitting here deciding, okay, are we going to go up? Are we going to keep going down? What are we going to do? Well, immediately following this, we have this candle here, still colored in red, because again, the code that formulates the coloring of these candles isn't going to be perfect. But we do see a couple things that tell us that we're now entering a new uptrend. And for one, we have this yellow up arrow here representing a cross back over of the 9 over the 21 for that. We have the green background. So the P star has flipped down to the bottom, representing an uptrend detection. The wick of the candle itself is green. So telling us that the default chart settings have painted this candle as a green up candle. So that is the indicator and the features of that indicator. Now, in combination with this, we also have this oscillator, again modeled after the auto trend system validator oscillator that works in combination with this. I didn't use any code from that one. I had to kind of piece this together myself, just kind of guessing some of the ways they would have assembled an oscillator like this, and then kind of tweaking it and refining it a couple times. And so we see that we use this oscillator, and this oscillator is set to the chart chart default. So basically, this is the 5-minute chart. So this is set to the 5-minute chart. So we use this oscillator as a way of validating these signals here, and basically giving us a heads up, an earlier heads up in many cases of change in market sentiment. We see here that when this signal fired for a down signal, we had this oscillator in red here. And if you look even, you'll see that the oscillator actually turned red before the signal fired here, giving us an early indication of a potential change in market sentiment. But you'll see that at the second candle is the end of this red area here, and then immediately following, it turns blue. So every candle past the second candle here is in this blue section. So you'll see that there is some conflict of communication here, right? We're seeing some disagreement of the indicators. This is why using multiple indicators to provide additional layers of confirmation is so important. If we had just entered just based off of this one signal without looking at anything else, this cross of the EMA or this oscillator down here, obviously we would have likely suffered a loss with this trade. However, we see the signal and we're going to wait for the cross of the EMA, the confirmation of the cross, which is this yellow down arrow here. But if we look, we see that that confirmation comes well into this change in sentiment within the blue oscillator. So when we see that conflict, that lack of congruence between our indicators, that tells us that maybe there's some indecision here. We should stay out of this trade. And that's exactly what I would have done. I would have waited for a strong, all green across the board, just like in NASA, when mission control wants everything green, all stations go. And I would have waited for maybe something like this. We have the cross up, the yellow right here. We have the green arrows firing up. We have the blue oscillator down here. We have the green background for the uptrending PSAR. This tells us this is a solid trade, not guaranteed, but has good potential. So maybe we should potentially consider taking this trade, which is what I would have done. If I had seen those many confirmations, I would have felt confident about taking this trade. I would have gotten in. And as you can see, it did manage to go on and actually provide some decent points. From here, from the signal up to here, it's almost 60, 70 points right there. That would have been a very decent trade for the day. That right there would have been all I needed to capture what I wanted as far as for winning for the day. So this is why, having multiple layers, multiple confirmations is so important. You'll see that there is not always agreement. That we have this kind of when we're looking at this to here, there's going to be disagreement where the indicators are going to say one thing and other ones are going to say other. Sometimes the oscillator will be wrong and the chart will be right. Sometimes the chart will be wrong and the oscillator will be right. But what we're looking for with this, in order to really find the best level of success, is we're looking for situations where we have the most agreement across the indicators, where we have very strong agreement. And ideally, when we have total agreement of the indicators, that's when you're going to have your strongest potential trades. For example, here, this trade right here, right? We have a green up fire of the candle, and we have it in the green background here. This is good. We have multiple points of confirmation, but we're waiting for total confirmation. So but you see that the background for the PSAR is still red here, and we still don't have that cross to the upside of our EMAs. So we're looking for that. We want that. So yeah, between here and this point here, when we do get that total alignment, yeah, we missed this little move here, but look what happens. It goes on and eventually comes to a point where here would have probably been an exit point. There's definitely some areas where I would have looked to maybe think about exiting, maybe when the PSAR flipped here, but we were still in blue down here. But when we start to see the indicators start to signal maybe a potential end, but again, even here, we didn't have total alignment of the indicators. So, we didn't have that strong confirmation of a reversive trend. So we may have still stayed in the trade. And if we had, we would have seen that from that point up to here would have been a phenomenal trade. This is 245. This is 327. So about an 80. Like I said, I'm just doing quick math in my head, but a really nice gain from here to here with a period of kind of flat consolidation right here that could have shaken some people out. This area right here would have definitely caused some concern because we would have seen change in the candle, oscillator is confirming. We got our down flip here and our red PSAR right here. Red PSAR starting right here. So this may have shaken people out, absolutely. And that would have been fair. But even if it had, from that point of entry here to here, that still would have been about 20 or 30 points. That still would have been a decent trade. That's the point of these indicators, is to try to give us as many levels of confirmation as possible, and provide sometimes provide safety nets. The point is that at this point, let's pretend that we were here and we'd seen this signal. We didn't know what was going to happen over here. We just saw this. And, we would have thought, okay, we have everything here showing that this is a potential reversing trend. Maybe this would be the time to exit, capture what we've won. There would have been nothing wrong with that. Absolutely nothing wrong with that. That would have been a win. Still, from here to there would have still been a one. Not maybe as big as this from what would have remained of this run up here, but it still would have been a win. And here's the thing about trading is you have to be dynamic in trading. So let's say that we had exited here and then we've seen this here, this flip to the upside here of the EMAs, then this uptrend signal in coloring of the blue candle, the PSAR flip, the green background, and then we also have the oscillator change back here. We just thought to ourselves, okay, so this was a false signal. Fine, let's re-enter the trade. And we re-enter the trade from here. And obviously this little dip right here, this is why you want to pay attention to your stop losses, and set your stop losses to be able to move. And that's why I put this little label right here. This is another feature of this ATR label. It stands for average true range. Average true range means that at this point, this is what the market, this is kind of the range of the market for this time frame at this kind of range. For me, honestly, I would actually put, I like to have the average true range oscillator on, because you use the average true range as a way, and this is kind of in the descriptions of the indicator, as a way of being able to determine what you could set your stop losses and take profit at. Let's say we entered this trade here, re-entered this trade here. Well, we see at that point that our stop loss, or excuse me, our average true range is 16.15. So that's the range that the market will move within this time frame. So if we're setting our trade here, we know that we need to at least have a stop loss of at least 16.61. So let's say we enter this here. We're going to adjust our stop loss accordingly, 16.61. So around, we'll just say there. Now we're going for a 2-to-1. That's our goal. Our goal is a 2-to-1. So if our average true range is 16.61, we know we need to target probably about a 33-point gain in order to have a 2-to-1. And you can see here ratio 2. It's about 33.5 right there. So you see from this signal here, it does come down, but look, it comes down only kind of about a quarter of the way, maybe a third of the way into our stop loss area here, and then it goes back up. and it ends up going to that 2-to-1 profit target, that 33 points up. If I had set this trade up, I would have set it to exit 75%. So if I had 4 holdings, or I had 4 positions, I would have exited 3. I would have left a runner, and maybe captured that additional 10, 10 and a half, 10 or 15 points right there. But a 33-point gain would have made me very happy. Times that by 20, or times that by the number. So here's how you do the math on that. You times the each point for Nasdaq's worth $20, and we know that our target went up 33. So by itself, that would have been $660. Now, that's just for one position. Let's say I had 4 of those. We're looking at over $2,600. So it doesn't look like it moved very far. But even just that amount right there would have been, a decent profit for a day. $2,600. That's, trust me, that's nothing to turn your nose at that. So that's just kind of an overview of how to use these indicators. Again, these are invite-only indicators. I'm not claiming to be, by any means a financial expert, obviously, and everyone who uses these indicators is going to have to do so at their own risk. Because I'm not saying that they're foolproof, because they're not. They will lose. Any indicator, any strategy you use will lose at some point. That's just the nature of trading. Trading is about protecting your capital and finding ways to increase your probabilities of success. So even though you may lose trades, how you manage the trades, your risk management, and how effectively you can manage your risk and protect yourself against loss, that will happen, with the goal of basically having better wins, better quality wins, and lower impact losses. That's how you win at trading. You have better wins than you do losses. Better wins than you have bad losses. So if you're doing a 2-to-1 or a 3-to-1 ratio, you can have a 50, 55, 60% win rate, meaning you're losing 40% of your trading. But as long as you're getting at least 2-to-1 on your wins, at some point, it's going to lead to a positive in terms of your total net profit. That's a powerful thing about trading. It's something I just want to briefly go into. It's just, everyone thinks that the goal is to try to get to 100% win rate, and very few people succeed at doing that. Almost no trader. We saw Bo. He had 100% win rate for a time, but again, at some point, there's going to be that loss, and that may be his only loss for the year. But he's no longer 100% trader. He might be a 99% trader, which again is nothing short of phenomenal for trading in an industry where 90% of traders fail. And the average win rate of those that succeed is in the 70s, 67. So, having one fail out of however many, having percent win rate, that's still absolutely incredible. Our goal is to try A, increase our chances of probability, and B, manage our risk, protect our investment capital. Our investment capital is our bloodline. It's the thing that keeps us trading. Once we run out of it, traders. Protecting your investment capital is first and foremost. That's why I like to use the ATR, the average true range. I like to know kind of what the market is moving at, so I can adjust my stops. And I'm not just adjusting my stops. If I'm making my stops bigger, I'm lowering the number of positions I'm getting into. So let's say that I on average I get into 4 positions, right? but I do that at maybe a 10-point stop loss. Well, let's say the market's going at 16 or 20, you know, these much higher levels here, like this 30, 32. I mean, that right there, I might be doing one position at that. At 20, maybe 15 to 20, I might do two positions. You know, for 10 or lower, I might do 3 or 4. You adjust, so you can adjust your risk and your position size. That's what I mean by position sizing. Your position sizing should be done in accordance with your risk management, as part of your risk management, using the movement of the chart to determine, okay, what risk management am I going to go for? If the chart's moving at 20, ATR, I'm probably going to want to have a lower number of positions. For one, and that number of reasons. One, because you want to try to keep your loss the same. Whether you're trading 4 positions or 2, you want your loss to still be around the same. 2, if the ATR is trading at a much higher level, you don't need as many positions. Say if you have 4, contracts or 4, 4 positions. So, that's part of this. It's not just seeing what the indicators are showing. It's also position sizing and risk management. Being able to protect yourself from loss, your account from loss. That right there, probably beyond this, is probably the most important piece of trading. This right here, again, once you know what these are showing and how they work, I mean, anyone could do that. Position sizing and risk management is, in my mind, probably one of the hardest parts of trading. And it feeds into the psychological aspect of trading, right? Where we don't like to lose. And sometimes we get into this mentality of, well, I can't lose, whatever. It's dangerous. Remember, when I said in my last video, you want to go in, or maybe not my last video, more options video. You want to go into trading every time you put a trade in as though that was lost capital. You want to be able to learn to be able to absorb losses. I'm not saying get happy with losses. I'm not saying go look out for losses, like seek them out. Most definitely not. But I'm saying you need to learn to become comfortable with losses, and as relatively comfortable as possible, as to be able to take a punch, so to speak. You don't like it. It's not something you relish, but it's something you can do and something you can learn from. And that's really what you need to do with your losses, is you need to learn or be able to learn from them. If you lost, if let's say you took this trade and let's say that instead of being in this up position here, you weren't in any position, and you saw this, and you decided to enter this position. You said, okay, I'm going to short the market here, right? And let's just say that based on the ATR, 16.38, we adjusted and they say you can use 1.5 times the ATR. For this, I'm just going to use 16. Put it wrong way. And let's just say, now we're doing, 2 zeros, so we'll just leave it at that. So this is what we target this. Well, obviously, immediately after we in this position, almost, we go into loss territory and we get into our loss. And we lose this trade. Rather than be frustrated, we need to learn to analyze this chart and come up with a lesson for the loss. We had a down signal, red parabolic background, cross to the downside and red in the oscillator. So we see to ourselves, okay, this should have won. Why didn't it? What could I have done to prevent this? And you see that following the signal here, this was the second candle was the last candle to be in the red of the oscillator, and then it turned blue. The wicks of the candles turned green. So maybe we use this loss to refine our strategy, to be a little more patient. Instead of waiting, instead of taking a signal immediately at the signal, maybe we wait a candle or two for confirmation, for additional confirmation, to make sure that the signal is valid. So we refine our strategy so that when we see a signal, we decide, okay, we're going to wait 2 candles before we enter the trade. If you'd done that, you would have seen that you would have been in a completely different situation where you would have seen there was no longer congruence signals, and that would have stopped you from entering that. That's how you take a loss and turn it into a lesson that can help you to avoid future pitfalls. And you adjust your strategy. You adjust and adjust and adjust. You're never going to reach 100% likely. Let's say never because you may. Your goal is to just tick those percentage wins up ever and ever higher. 1 or 55, 60, 61, and get to a 70, 75, 80%. You're going to be in the top tier of traders. And that's how you just progressively. That's it for this video. I hope you enjoyed it. Again, if you want access to these indicators, just